Hi there, I'm Brendon Ojala. I'm a mortgage advisor and director of Velocity Financial. One of our experiences that is often harder to buy your second home than to buy your first home. And the reason for that is you've got two things going on. You've often got an existing house and mortgage and you've got a new property you're trying to purchase. So we're going to talk a little bit about the options for you when you're trying to buy your second home. Do note that I'm going to try and keep it as simple as possible, so we're not going to discuss things such as real estate agent, lawyers' fees and things like that. Do also note that this is class advice, so it's not specific, and so if you're wanting to do something based on this information, then let's talk first so we can make sure that the advice is personalised and does suit your situation. In short, there's 5 different options you've got when buying your second house and what to do with your first house. So I'm going to talk those through as briefly as I can, and hopefully there'll be something in here that's relevant for you. So the first option in terms of buying your second house is that you can sell your house first, sell your existing house first. So the example I'm going to use in all of these situations is that you've got a $500,000 house with a $200,000 existing mortgage, and you're wanting to purchase a second house for $1 million. So under this option, we simply sell your first house. You put $300,000 in the bank. That's the difference between the sale price and the mortgage. And then you need a $700,000 mortgage to buy your second house. So we go to the bank, ask for a $700,000 mortgage, and purchase the $1 million house. So that's option 1. The advantages of this option is that it's quite simply the easiest way to get money out of the bank, because there's not 2 things involved. We do one thing first and then the second thing. The disadvantages is first you've got to sell your property before you're in a position to buy your second place. Now that's okay, but what if the market is rising? There's a fear that you might have sold for a price and then you can't find a new property, so house prices keep rising and you get moved out of the market. The other challenge, of course, is that you've got to live somewhere in the meantime. So those are some of the disadvantages of this option. Let's go to the second option. So option 2. Option 2 is that you make an offer on a new house, but you have a contract that's conditional on selling your house first. So let's talk this through step by step. Firstly, you make an offer for $1 million on a new property, and that offer is conditional on finance and conditional on selling your house. You get it accepted, and then we go to the bank and ask for a $700,000 loan. Now that $700,000 is your final position, less the equity you'll have when you do sell your house. Then you've got to go and sell your house, and let's assume you sell it for $500,000. You've got to get your house under an unconditional contract. When you do that, you can go back to the person you're buying your new house off and confirm the contract. Then when it comes to settling, you've got to make sure that you settle your existing house on the same day or before you can settle the new house. And at the end of all those transactions, you've got one house worth $1 million with a $700,000 home loan against it. The advantage of this is that you don't have to be out of the market, so you don't proceed until you know that you've basically got a new house under offer, and then you can proceed and sell your house without risk of being out of a house and without the risk of having to own 2 houses. One of the key disadvantages, though, is that your offer on this new place is less attractive because your offer is conditional on selling a house. And particularly in a really hot housing market, it's very difficult to get that offer accepted because there's likely to be other offers on that property that are unconditional, or at least have less offers than yours will have. Even if you get that offer accepted with your house sale condition, it's very likely that the vendor or the seller would have put a clause in there to say if a better offer comes along, that you've got 3 or 5 days to accept the new offer, the new house unconditionally, or else they're able to sell that to somebody else. So there's still a risk through that period that you're going to lose out on the purchase, and that's even when you've spent the money marketing your current house. And you do still have to sell your house, of course, or else you can't complete the transaction. So there's some disadvantages there. Let's talk about option 3. Option 3 is simply that you keep 2 houses and you choose to rent the first one out. So let's look at how this might work. So firstly, you would look at your existing house, $500,000. You'd get a rental assessment on it, and let's say it rents out at $500 a week. You'd then get finance from a bank for the whole $1 million to purchase the next property. And then what you'll see is that you've got a mortgage of $1.2 million. That's a current existing mortgage of $200,000 plus the new mortgage, and you've got $1.5 million of property. So that's the scenario that we'd pitch to the bank. The advantages is that we can include some more income to help service a bigger debt. So we've got $500 more a week to help service that increased debt. It can also be an easy way to start your investment property. And obviously, if you've got two properties in the market and property prices go up, you've got potentially a lot more property that can go up in value, so your equity will build quicker than if you just had one property. And you'll always have somewhere to live, and you can always sell that first house at any stage. So you do have some options there if your circumstances change. The disadvantages is that you might not want to be in the investment property game, and so this might not be the option for you. Your first house might not be a good investment property, and there's reasons for that. It might not be in a good location, it might not have enough bedrooms, it might have too much maintenance, and so it might not be a really good option there. Also, it's obviously the loan is bigger, and so we've got to get that approved by the bank, and you might not have enough income or enough equity for the bank to prove a whole another $1 million of lending. So it can be more challenging to get lending in this scenario. So that's option 3. Let's talk about the fourth option. And the fourth and the fifth option are two variants on the same theme, and that's bridging finance. So we're going to differentiate between open bridging finance, option 4, and then closed bridging finance, which is option 5. Let's talk open bridging finance. Open bridging finance is when you've got your existing house with $500,000, $200,000 mortgage, and you purchase a new house for $1 million. We go to the bank and say, hey bank, can you lend us $1 million just until we've got our first house on the market and sold? The bank agrees to that, and so we proceed, we secure the first property, and then we try to sell our existing house, and when that sells, we repay the debt by $500,000, and we end up in the same position, $1 million house with a $700,000 loan. Through that bridging period, however, we'll have a $1.2 million loan against $1.5 million of property. So that ratio is key. That ratio is called the loan to value ratio, 80%. But the other key thing is the bank won't assess you as having 1.2 million of property. They'll look through that to the final position, which is again $700,000. So that's what open bridging finance is. You don't have to have a contract on your existing house. You just have to have the intention to sell your existing house. I need to say that in the current market, that's of November 2019, only one bank in the market, one mainstream bank, is considering open bridging finance. In other words, only one bank is looking through that open period at your end position. If we can't get it done at that bank, we're looking at non-bank options. Okay. The advantages to open bridging finance is that we don't have to be able to service 1.2 mil. We only need to be able to service that 700,000. If the bank doesn't do it, a non-bank isn't even going to look at the income at all. It's going to simply make sure there's enough equity and we can potentially get this approved. What it does do is it buys us some time. It means we can make cash offers on the new property, and it gives us some time to sell our existing houses. The disadvantages is that for a period of time, you've got a big loan, you've got a $1.2 million loan, and you've got to service that. Now, you might be able to service that at the bank, or if we need to go to a non-bank, not only do we need to service a higher interest rate, but there's potentially going to be some fees and some valuations involved as well, so there is going to be a higher cost. And the question remains, what if you can't sell that property? Then you've got a sticky situation where it's costing you significant amounts, and if you can't sell your existing property for whatever reason, then in the long term we have a pretty significant challenge on our hands. The last option is called closed bridging finance. This is really just to assist with timing. And the timing is that you have an existing property, you've then bought a new property. But the key, what makes it closed bridging, is that you've got two unconditional contracts. So before you manage to purchase the new property, you've got an unconditional contract on your existing house. So what we find is it's really just a timing issue. And the timing is that you've got to settle the new property before you can sell or settle the existing property. The bank's comfortable because they know you've got an unconditional contract to sell, but just for a period of time we need to have $1.2 million. So any bank's going to do this because they've got confidence that your house has sold. We've just got to bridge that period for a while. So that's called closed bridging finance. It's a little difficult to organise our timing, but it is certainly an option we can consider if you can get two unconditional contracts. So the advantage is that banks will calculate again the end position, the 700k. There's no risk of being homeless because we've got two contracts, and there's little risk involved because we've got two unconditional contracts. The disadvantage is just the challenge of setting up our timing correctly because we've got to have two unconditional contracts, and it can be a little hard to get our timing right on this, so that's the disadvantage of this option. So those are the 5 options. I hope I haven't overwhelmed you, but if you are going to buy a second property, you're going to be doing one of those 5 options. So if that's relevant to you, what we need to do is work through which of those applies to you and make sure that we can make this as smooth as possible and get your finance organised in a way that suits you and is going to work. Obviously, every situation is different, so we do need to talk through that with our clients to make sure we've advised the best situation for their particular situation. I hope that's been of use to you.